Hello, I'm Dami Coker, and thank you for joining us for this webinar. I'm joined today by Felix Goltz, the Research Director at Scientific Beta, who is going to tell us more about the risks of deviating from academically validated factors. Hello, Felix. Thanks for joining us today.
Hello.
Now, factor investing in the equity space is increasingly popular. And with this increased popularity, the lines between academia and practice are becoming increasingly blurred. Ever since the emergence of factor investing, it has always been characterized by one aspect, the fact that it is entrenched in academically grounded research. Now, many providers claim to follow this logic and state that their factors are the result of broad academic and practitioner consensus. However, we know that this is not always the case, and we will explore this in more detail. So if you have a question during the webinar, please submit it through your interface, and we will try to answer them before the session is over. Okay, Felix, so let's start by going back to the basics. Scientific Beta is advocating that investors go back to using the broad consensus of academically validated factors. So let's start by looking at what exactly these factors are and what asset pricing models are they based on.
Yeah, so there's indeed a lot of empirical research that tries to come up with an answer to this question. What is actually the set of factors that we can use to explain differences in return levels across different stocks, or differences in return levels across different portfolios of stocks. So that's the question. And again, there's lots of different studies. Obviously, across all these different studies, there are differences in results. And if you look across the empirical literature, you can actually count a large number of factors where you will find maybe one study that actually proposes this factor as a rewarded factor. So there are different meta-studies that have actually tried to come up with a list of all the different factors that at some point have been put forth in the literature. So these studies come up with lists that contain hundreds of factors, around 400 factors for a lot of these studies. So there are all kinds of different factors that have been proposed by a single study. But then you also have studies that really try to look through this large number of factors and try to see, well, what are actually the factors that are consensual. So, of course, it could be that there is a single paper that on a given sample finds a given factor. And again, there's probably 400 of those. But these results may actually not be validated. So there may be other studies questioning the results on a specific factor. And so this whole process of analyzing the data, coming up with factors, others replicating these results, has led to a kind of consensus where you can say that, well, today there are a few models that contain a limited number of factors, and these are quite consensual. So these are the models, and this is the set of factors that is the most widely used, for example, to, of course, explain differences in returns in general, but also in applications. So if you want to evaluate performance of active managers, for example, there's rich literature on this. If you want to, for example, analyze corporate events and you want to actually back out the abnormal component of returns versus the normal component of returns, there are these workhorse models that contain a limited number of factors, and I'm just providing here an overview of what the usual models and the usual factors are. So there are different models that we look at here. So those include quite classic models like the one by Farmer and French and Carhart, which were published in the 90s. Those contain 3 and 4 factors. More recent models, like the Farmer-French model from 2015, actually augment these earlier models and contain a larger number of factors, so 5 in that case. And also you have some more recent studies that quite extensively compare different factor models containing different sets of factors, and they really try to come up with a question, well, how many factors do we actually need, and what are the factors that we need? And what you can see here across the studies is that there is a consensus that there's a limited number of factors, so typically something like about a handful of factors. So those are indicated in the white boxes here. The definitions of these factors are also very similar across the studies, and they're very simple definitions. So if you just look at the momentum factor that's included in most of the recent models, it's just based on past stock returns. There are no complex combinations, no adjustments. So you really have a limited number of variables, and you have a great deal of consistency across the different models. What is suggested here also is that there are a lot of factors that maybe investment practitioners talk about and product providers often include, like growth, liquidity, the yield factor, and these are actually not included in the standard models. So what really characterizes, I think, the standard models is this parsimony. There's actually a relatively low number of factors, and we can ask really, why is that the case? So why do we have, on the one hand, hundreds of factors where we have some evidence that they may lead to a reward, and then on the other hand, these consensual models only contain a handful of factors? And the answer is quite simple. It's simply that if you increase the number of factors, then of course you also increase the risk of a lack of robustness, because if you have a large number of candidate variables, you could always find one of these variables that is relevant in a specific sample, but those results are not likely to hold more generally. And so what the consensus has produced is clearly a parsimonious model that is actually more likely to be robust when it's tested across different samples. And so this is the kind of the standard starting point really for multi-factor investing, is that we have a limited set of factors that have not just been shown in one study, but where there's actually a consensus, results have been replicated, and across many different studies, these factors have been confirmed.
Okay. Now, looking at your last slide here, you mentioned that the objective is to capture truly rewarded factors. And that sort of implies that there might be some factors that exist, but they are not rewarded. So can you expand on that a bit? What's the difference between rewarded and non-rewarded factors?
Yeah, so this is an important difference. I think it's a useful clarification. So when you talk about factors, of course, you have actually two quite different objectives that you could achieve by using these factors. So one objective is you want to really identify what drives the differences in long-term returns. So there are assets that have a higher level of return in the long term than other assets, and you can explain that through exposure to some systematic factors. So that means you can use these factors to explain differences in long-term average returns, or in the level of returns. Now, you could have a different objective, which is not explain the level of returns, but simply explain the fluctuation that you have in a portfolio. And so there can be all kinds of factors that could be useful to explain variability of returns, but that may not lead to a difference in the long-term level of returns. And I think this is important to specify, because when we say that there is quite a limited number of factors where there is consensual evidence, this of course is true for factors that capture differences in return levels. If you're interested in capturing variability in returns, there could be all kinds of factors that are useful in capturing this variability. And I'll just illustrate that with a simple illustration here. So a very useful example is anything that is related to industries or sectors. Okay, so there is simply no evidence that being exposed to a given industry, like technology or utilities or other kinds of industries, leads to a specific risk premium that would be different from risk premium on any of the known factors. However, the fact that you have exposure to a certain industry can, of course, explain the variability of a portfolio. So we just illustrate that here. We created a simple kind of industry-based factor. So this is just kind of long technology and short utility stocks. And we're then looking at the influence of this factor on an equal-weighted portfolio. So what we can see is that if we want to explain the fluctuations in the equal-weighted portfolio, this has a positive loading on this technology minus utility factor, and that actually captures about 20% of the variability of outperformance, if you will, of this equal-weighted portfolio. So this industry factor is useful. It helps you capture how returns of the equal-weighted portfolio vary. The second question is, does this kind of factor help explaining the differences in return level between the equal-weighted portfolio and the cap-weighted portfolio? And here we can see that actually there is no significant premium. So basically being long technology and short utility stocks doesn't provide you with any premium. You just get zero returns in the long run. But of course, this is a factor that has a lot of fluctuation, and a portfolio strategy could be exposed to that fluctuation. So if you just want to use factors to explain variability in returns, the requirements are probably less stringent. There could be all kinds of factors that could be useful, especially for particular portfolios. So the question we're asking here is really, what are the requirements for factors that explain differences in returns, in levels of returns?
Okay, and over the long term as well. That's the key. Great. Now, in theory and academia, this is all well and good. Things are quite clear. However, we know that when it comes to actual investing in the actual market, commercial providers do not always follow this line of thought. They often move the goalposts in terms of their definitions of factors. So can you shed some light on some of the analytic toolkits that are out there? Or what are the commercial index providers putting out there on the market?
Yeah, just very broadly, you can, of course, different tools will have different factors and different specifications. But what you can say in general is that there are a lot of tools that just really use a very large number of factors and a large number of variables, and that's really a contrast with the models in the academic literature, which again are quite parsimonious, and there's just a handful of variables. So if you look just as an example across some providers, you see that a lot of the analytics tools will actually draw on something like hundreds of variables, so 500 variables, sometimes thousands of different variables to actually define factors. So that's in stark contrast with an academic literature, which really just draws on 5 factors. And another striking difference is not just the number of variables, but is really the process by which variables are used to create factors. If we think back to the models in the literature, we mentioned the factors are very simple. So the momentum factor, for example, is typically just you look at a stock's return, and you're just going to sort stocks based on the past return. And there's not a great deal of adjusting for additional influences. There's not a great deal of combining different variables. The definition of the momentum proxy is really very, very simple and actually relies on a single variable, which is straightforward. What we see from providers is that providers have quite a complex process. So I represent that here with this pyramid. So the pyramid just says that there's basically different layers of creating complexity. So if you go to the bottom, that's probably the most relevant layer. So in this layer, we see that there is a variable selection layer. So if you look at, the usual databases, of course, you can easily come up with thousands of variables on a given firm. So just think about accounting numbers. You can use accounting numbers to create, differences, ratios. So you can literally create thousands of accounting ratios and then select one of these accounting ratios. So that, of course, gives you a lot of flexibility and allows you to search across a lot of possible variations for a given factor. Now, once you have selected a variable or several variables, providers actually add a second layer of flexibility, and that layer is a layer of creating a composite factor. So typically what we see is that different variables are combined to actually create a factor definition. So, say for momentum, you would just look at the past returns, but you may also look at, this kind of the change in trend around these returns, or you would look at returns after you have adjusted, perhaps for different risk exposures. And so you would actually have a set of different momentum variables, and then you would combine these in a composite variable. Now, the issue with these composite variables is that, again, you're increasing the amount of flexibility because if you take 100 variables, you have 100 ways of selecting one variable out of these 100. But if you took combinations, of 3 or 4 or 5 of these variables, of course, you're increasing the number of possibilities, far beyond just 100. And so you can actually test many more combinations. And the flexibility doesn't stop here. So there's typically a final step of flexibility, which is to actually add some country or sector adjustments, which could be implemented quite selectively for some variables or for some factors. So you end up with literally thousands or more variations that you could conduct and you could test for a given factor. Now you may ask, what's the problem with having so much options, so much choice? Well, the problems really depend on the process that you use. So what we see from providers is that they use a process where they have maximum flexibility, and they use this flexibility to create factors that have good performance in a backtest. So providers are quite explicit about that. So the process, is typically not to find variables that are easy to implement, or to find variables that have a good economic rationale, or to find variables that are very robust across different samples. But instead, what is usually sought is to have high performance for a factor in a given sample. And this approach, this process, you can actually describe that quite formally as a process that maximizes the risk of data mining. So if you think about the critique of empirical analysis, the typical critique is that analysts have lots of flexibilities to seek out effects in the same data set, and so ultimately they're going to end up with spectacular results simply by overfitting the model to the sample. And you can clearly see that providers have an approach that basically maximizes the data mining risk, and that's a stark contrast again to the very parsimonious definitions in the literature, which precisely don't offer this flexibility and hence don't come with this data mining risks. So you can illustrate this data mining risks. Just a simple illustration here, just to show that what are the consequences of giving yourself a lot of flexibility. What we look at here is simply we look at a backtest of 5 years, and among 10 candidate definitions for the value factor, we're trying to come up with the best one. So we just look back over the past, and we find the value metric that has given the highest performance. We can see that by doing that, we actually increase performance by 1.5%. This is relative to the standard definition in the academic literature. So by using hindsight, we're always choosing a variable that has better performance, and we could show a backtest that has a benefit of 1.5%, an increase in returns of 1.5%. Then what's interesting is to look at what happens out of sample. So when you lose the benefit of hindsight, we can see that actually these winning definitions actually have an underperformance of about 2.5%. And so what this means is that the backtest that you show, if you use hindsight to select the winners, is basically overstated relative to what you should expect. And this level of overstatement in this case is 4%. So that's just a simple illustration. Of course, we're only selecting among 10 variables. So in practice, providers probably have a lot more flexibility. But this just shows that all this complexity can be used to kind of overstate backtested results. And these effects, they don't exist simply for this first level of flexibility for the variable selection, but these effects also apply to the second and third level of flexibility that I showed in this pyramid. So if you go, for example, to the step where you define composites, some providers create composites by reweighting some of the variables. So if you choose 3 different variables to define, say, a quality factor, some providers will say, well, we will just give maybe 10% of weight to one variable and 60% to the other. So these kind of weighting decisions, again, can have a huge impact on the performance that you show. And just to illustrate that, we just looked at different quality definitions here, and we look at the return differences. So one quality definition gives a weight of 30% to investment, 60% to profitability, and 10% to leverage. And then we look at another definition using the same 3 variables, but simply changing the weights. So basically, instead of giving 30% to investment, we give 60% to investment, and instead of giving 60% to profitability, we give 30% to profitability. So we just change around these weightings, and what you see here is the return difference between these 2 portfolios. Again, both of them represent a quality factor. Both of them are based on the same variables. The only thing that changes is the weighting of these variables, and you can see that there's quite pronounced performance differences, up to something like 5 to 10% in magnitude in terms of annualized returns. And so clearly, this flexibility can allow providers to dramatically increase the performance that they show for back-tested portfolios.
Okay. Now, with so much complexity and these composite scores and the flexibility that providers have, don't they run the risk of discovering factors that are essentially insignificant or maybe redundant anyway? They've already been discovered, perhaps.
This is an additional problem. So, so far, what we really discussed is the risk of finding false factors. So by just giving yourself a lot of flexibility, you could uncover false effects in the data, and clearly the process that we observe is such that this risk is probably maximized. In addition to that, you have a different type of a problem, which is simply that a lot of the factors that you may discover, they could just be explained by the fact that this factor is simply a repackaged combination of factors that already exist. And again, this is probably one of the reasons why in the consensual academic models the number of factors doesn't increase, because one of the tests that is typically required is when someone in an academic study claims that he has found a new factor. Well, the first question is, okay, but does it add any explanation on top of value, momentum, profitability, investment size, and similar factors that we already know are rewarded? And this again is quite different in a lot of the product offerings. In the product offerings, we see that some of these tools and indices actually include factors which have clearly been shown to be just a repackaged exposure to already existing factors. So a prominent example is the dividend yield factor. That's a very popular factor. But actually, if you look at the returns to the dividend yield factor, you can see that tilting towards dividend yield actually gives you exposure to the value factor as defined by book to market. So if you look at the exposure of the dividend yield factor, you can see that, well, there's slightly negative exposure to the market factor. Okay, so dividend yield stocks, high dividend yield stocks tend to have a lower market beta, and also they tend to have value exposure. So they tend to be correlated with portfolios that tilt to book to market. And when you adjust for these effects, you actually don't find any outperformance for the dividend yield factor. And so this factor, you could clearly say, is a redundant factor, and it doesn't have any interest per se on top of the kind of premium you already get from tilting to the value factor.
Okay, that's interesting. Now, in terms of factor exposure, then, what are the consequences of perhaps using these proprietary factors?
Yeah, so there's a very kind of straightforward result of using proprietary factors, and that's really a risk of misclassification of a strategy. So there's a risk that when a provider offers an index that claims to tilt towards a given factor, that actually have some unintended exposures. So I'm providing an illustration here. Let's look at a quality factor index. So this quality factor index will have, let's say, a commercial definition of how to define quality, and that definition will be different from the academic definition. So just to go back to the factor models that have been documented in the academic literature, these models typically include two factors. One is low investment factor. So low investment firms which invest more conservatively tend to actually capture higher returns in the long run. So that's one of the factors. Another factor is a high profitability factor. So companies with high gross profitability, for example, tend to have higher average returns. And so the question is really, well, these are the quality-related factors. So what about commercial quality indices? We would expect that they get positive exposure to these factors. We would also expect that a commercial quality index, in principle, should not have additional exposures to things like size and value, which are clearly separate factors from the quality factor. So the question is really, for this case of a commercial index, what are the exposures that you get? So you can look at the impact on the performance of the different factors. We broke this down in percentage terms, and you can see that only 32% of the performance are actually driven by exposure to the profitability factor. Zero of the performance is driven by exposure to the investment factor, so that's already a surprise. You only get exposure to one of the quality factors. Zero exposure to low investment, which is another quality-related factor. And also what's perhaps more surprising is that you get all kinds of other exposures. So we would argue these are unintended because we see exposure to size that drives about 9% of the performance. value drives about 10% of the performance, momentum drives about 5% of the performance. So clearly, if you accept the label, and this is a quality factor index, you wouldn't expect that 25% of your performance is driven by size, value, and momentum, which are not quality factor, but which are other types of factors. You can also see that 15% of the performance is driven by differences in market beta, so you're getting a different exposure to the market factor. Again, that's perhaps not obvious from the decision to tilt to quality. And finally, perhaps most surprising, 30% of the performance is actually not driven by any of these factors. And so you can clearly see that using a proprietary definition gives you, quite inconsistent exposures relative to the label that has been used.
Okay, great. So just to summarize then, what are the main takeaways? What should investors be on the lookout for when it comes to factor investing?
Yeah, so I think that there's two key takeaways which I would like to emphasize. So the first one is really related to the process. So again, it's not so much really whether providers may introduce slight deviations from a factor as it is found in the literature. The real issue is the process that providers use, and we've seen that providers basically create a lot of flexibility to find factors that have high performance in a sample. So what that means is that most of these factors are actually likely to be false. So that's very clear because you're maximizing the risk of getting false results. It's well known that by simply analyzing a sample, testing hundreds or thousands of variables and retaining the ones that have the best performance, you're likely to detect false results. You're going to find false positives, and you're not likely to confirm these once you put this in a real investment perspective. So this is a key risk, again, that is mainly really related to the process that providers use. A second important takeaway, I think, is just what can actually investors do to actually make sure that they don't face these risks. And there's really three precautions that investors can take. So the first precaution is really to say, okay, is there any independent research that validates the provider's factor definition? So if the risk is that you rely on a process which might be flawed, well, the best safeguard really against this is, go outside the process of a specific provider, see whether other researchers have actually replicated the results. And this is clearly a benefit of the widely published factors in the academic literature. So there's not just one paper or one author that has published this factor, but there are actually hundreds of studies that actually try to replicate these results. And of course, a lot of these factors will fail to replicate, but the ones that persist, they are likely to be more reliable. So, unfortunately, we don't see a lot of studies that try to independently replicate factor definitions of providers. And of course, one reason could be that these definitions may not be entirely transparent, and there may just not be any incentives to replicate kind of commercial factors. There are a lot of incentives to replicate results in published papers, and there's a lot of criticism among different researchers. And so if things have survived this process of independent replication, we can assume that the results are more reliable. A second question is really going back to the basics and saying, well, is there any formal economic explanation for the factor? So there are lots of different explanations for academic factors. When providers introduce new factors, they should have a clear economic explanation why the enhanced value factor actually works better than the value factor. And quite often, instead of delivering explanations, we see simple backtesting. And so investors should clearly question what is the rationale for the improvement. And finally, a very common sense question to ask is also what is actually the robustness of any factor. Again, here in the academic literature, there are lots of robustness tests. So studies have analyzed whether factors persist after they have been published. Again, this is something we would also like to see from provider definitions. There are studies checking whether the returns survive after you take into account implementation. Again, I think it's interesting that probably a lot of provider-specific factors, they are created without even considering transaction costs. And finally, we also need to adjust for the fact that there's potentially hundreds of variables that have been tested, and these adjustments have been, again, applied to the factors that are used in the academic literature. So this is quite a recent development, but this is now required typically for any publications around factor premia. Given that providers, quite obviously test hundreds and thousands of variations, they would also need to adjust for the number of variations that they test. And so these are really safeguards, and these are questions that investors should ask when considering any factor.
Okay, great. A nice short checklist that investors should consider whenever considering the appearance of new factors. Now, what I want to do is open the floor to our audience. So we will now take some questions from the audience. If you haven't already sent across a question that you wanted to ask, please do so now, and we'll try to answer it before the end of the session. So Felix, let's have a look here. So here's an interesting question. Are there sometimes legitimate reasons for deviating from academic factors? For example, you mentioned that sometimes transaction costs aren't taken into account, practical implementation of indices. So are there genuine reasons why maybe some providers do deviate from the academic factors?
Yeah, I think that exactly what investors should do is question any factor and any factor definition that includes even the consensual ones, and a good reason to really consider maybe the details of how the factor is implemented is precisely things like liquidity transaction costs. So it's true that a lot of the evidence in the academic literature will actually abstract from implementation. So a key issue is really to consider whether these factors can be implemented. There is actually a lot of evidence in this area. So some of the factors, for example, that have appeared in the early literature generate very high turnover. So things like short-term reversals, for example. And there's lots of criticism and there are tests that question whether this can actually be implemented. So this is, of course, a very reasonable question. And then a good question is, can we still implement exposure to that factor in an implementable way without having too much transaction cost? And there's actually different mitigation techniques that you can get exposure to the standard factors, but actually using things like buffer rules and using other techniques to mitigate turnover and transaction costs. And these are really clear questions. So I mentioned that the real question is about the process. And I think it's clear that from my description of the process that the problem is that providers often try to improve performance in the backtest, and that's the wrong question to ask. They should probably ask a different question, which is how do we actually implement these exposures, and how do we actually implement these factors, given that there are transaction costs and there are liquidity constraints, and these are really good reasons to consider how to implement the factors.
Okay. Another question here is relating to the low risk factor. What are your thoughts on that? There's been a lot of debate as to whether the low risk factor is one of the academically validated and robust factors. So interesting to hear your thoughts on that.
So yeah, for the low risk factor, this is one example where there is debate. I think more generally for all of these factors, there is an ongoing debate, and I think that's really what makes them interesting. So there's no definite result, and when we say that, there is an element of security by relying on kind of established factors. It's simply because there is a lot of debate, and despite all that debate, despite all the criticism, these factors reflect the current consensus. The consensus, of course, can evolve, and that's true for any factor. And I think investors precisely can benefit from this kind of scrutiny that different researchers apply by actually criticizing results. So if you think about the low risk factor, it's true that there's been a lot of debate. So there's differences between low risk factors that use more the beta as a risk measures. Others use different kinds of volatility measures as risk measures. And there has been a lot of questions on the low volatility factor, for example, from when it has been published. So this is a factor that could, for example, lead to implicit exposures to other kinds of risks, like short-term reversals, for example, at least for some definitions of the low volatility factors. There's lots of evidence on the low beta factor. Again, here recent papers question whether the low beta factor is really an independent factor. Is it not something that is specific to the construction of the factor and could be explained away by things like exposure to low investment and profitability? So this is, I think, useful for investors that there is this debate, and they should definitely question the factor menu that they're using. But I think the key benefit is that there are strong incentives, for different authors to actually question the results, and so we clearly don't see the same level of scrutiny for provider-specific factors.
Okay. Now, here's another question. This is more about the definition of the nomenclature. How do you define the investment factor? I think we showed some metrics showing investment as part of the quality factor. So what's your definition of the investment factor?
We draw on the standard definition as used in the papers that we cited there. So the low investment factor is simply an asset growth factor. So you basically look at the total assets of the firm, and you look at the growth of total assets at one point in time. So basically, it has been shown that firms that have a low growth of total assets actually tend to have higher returns. There's an economic rationale for that, which is basically related to the cost of capital of those firms. So firms that tend to invest conservatively, those are the firms that have low asset growth, and they do invest conservatively because they have a high cost of capital. So it's actually difficult for them to find investment projects that would generate a positive net present value. And so they actually invest conservatively. And so that's why these firms tend to have higher expected returns. So this is, I know the investment factor is not widely used in implementations, in analytic tools, but it's clearly included in the recent asset pricing models, and we just follow that factor definition.
Okay. Another one that's slightly related, taking into account the quality factors, or actually removing them, are 6-factor indices better than 4-factor indices? Because I guess the 6-factor indices include the quality factors of low investment and high profitability. So is there any benefit to 6-factor indices over 4-factor indices, or the other way around?
Yeah. So what you see with probably multi-factor allocation in general is, of course, that you have a benefit of when you go from 1 factor to 2 factors and then from 2 to 3, is that basically, well, if all these factors capture a premium, but these factors are not perfectly correlated, then you can actually get better risk-adjusted returns by actually combining those factors, and that's exactly the effect that you get from moving from 4 factors to 6 factors. Then I think the question of the factor menu that investors use is really something that investors need to form their own investment beliefs. I think that's part of their homework. So are they actually confident that these factors deliver a premium? And so this is where you can make a difference or a distinction between low investment and high profitability and the other factors like size, value, momentum, and low volatility. And that distinction is simply in terms of the amount of evidence that you have. So factors like low investment and high profitability, we have published papers that introduce these factors, which go about 10 years back. And so we only have about something like 10 years of post-publication evidence. It's different for the factors like size, value, and momentum, where we actually had published results in the early 1990s. And so we have about 25 years of post-publication evidence. So if an investor is very conservative and wants to see lots of post-publication evidence on a factor, they may still be prudent and not include the low investment and high profitability factors. If you're convinced of these premia, and I think there's reasons, there's strong empirical evidence, but there's also a theoretical rationale behind this, then of course you will benefit in terms of increasing the number of factors. You will benefit in terms of risk-adjusted returns, because you're spreading your exposures across a larger set of factors which are not perfectly correlated.
Okay. Next question here is interesting in terms of looking at the value metric. Now, price to book is used as the general consensual metric for assessing value, but can you discuss the criticisms that some people have of price to book as a value metric, and maybe there are some other commonly accepted metrics such as price to earnings or price to cash flow? Is there any merit to those criticisms?
Yes, sure. So I mean, I mentioned the process that we see in the literature, and so there is probably more than 50 papers, if you only look at the top journals, that propose some alternatives to the book to price. Of course, you can ask then why should these metrics be better, and is it simply that in a specific sample you see that results are better? So there is, for example, a pretty influential paper in I think 1994 by Lakonishek, Schleifer, and Vishny. So they basically proposed that instead of using a book-to-market ratio, you should use things like cash flows and also the sales growth to actually come up with a value metric. So these results again have been around for more than 20 years. And yet they have not been, popularized. They have not led to a replacement of the book-to-market ratio. There's always been criticism, and the question, of course, is that these studies that show that you can do something better, are they sample-specific or are they actually replicated again, and do they actually lead to a replacement? So there's lots of there's criticism, for example, that you can have in terms of the in general the reliance on accounting metrics, right? So of course we know that accounting metrics, are subject to massaging, if you will. So you can actually make some discretionary decisions on, how to report accounting metrics. So if you take the book value at the end, that will of course be influenced by choices on accounting metrics. But the book value has the advantage of being a very high-level metric, and it also has the advantage of being a stock. Right, so the book value is not affected heavily by a firm deciding to push profits, for example, rather in the future versus reporting them now, or rather reporting them now than pushing them in the future. So that's a benefit just in terms of robustness over flow variables like the earnings. So earnings, of course, are heavily affected by massaging. And the question I always ask is for when I see price earnings being used is, well, which earnings do you actually use? And different providers will use current earnings or future earnings in terms of consensus expectations. Of course, you can use more kind of high-level earnings or more precise earnings measures where you do adjustments. So which kind of definition of earnings do you use? So if you think about data mining risk, of course, it's good news to have a variable that is not, that doesn't give you a big degree of flexibility. And so that's where you just have to question also some of the results showing improvements. There can be more fundamental issues with book-to-market. So there's a recent study showing that it actually adds value if you distinguish between the retained earnings and the contributed capital. So both of them will end up, if you will, contributing to the book value. And actually this recent study shows that the contributed capital component is not priced, so you may actually separate out different components. So there is lots of questioning innovation, and the question is just, well, these proposals, when do they make their way into the consensus? And that's going to be when there's not just one paper, but when actually this has been replicated over and over again. And I think when we say there is a consensus, that consensus is not fixed. That consensus can evolve, and it's useful to observe that.
Okay, great. Well, those are all the questions we have for today. But thank you, Felix, for your insights as always.
Thank you.
So there you have it. We believe it's high time to remind the investment community of the promise of factor investing. And sticking to academically validated factors is the key message. So for more thoughts on and detail on this topic, please consult our white paper, which is available on our website, www.scientificbeta.com. Feel free to send us more questions to webinar@scientificbeta.com. And lastly, please make sure you follow us on social media. We are present on LinkedIn, on Twitter, and on YouTube. So thank you for watching today, and goodbye.